Hey, hello. Right. Hopefully somebody can hear me. Can somebody just
Yes, we
say,
can hear you.
cool, man, cool. Um, okay. Thank you for coming. Um, so it's kind of funny because I kind of had this whole topic prepared about discipline and along those ways. And the market is so hot this morning that this whole kind of thing is going to go over people's heads. Um, I feel like the market really needs to take a bit of a breath. Um, but I'm not in the game of predicting the future. I'm in the game of trying my hardest to pick out companies that I believe are going to be more profitable going forward. It's a different setup, really. Um, what I wanted to talk about here today is about discipline comes from not having to react all the time. So when the market is kind of moving a lot, people feel like they should be doing something, particularly like in a day like today, perhaps where it's really, really green. People are like, oh, I gotta do something. And, you know, investing is about being relaxed, being focused, understanding that what's the most important aspect of all this that we're trying to do, all of it, is we want to build a system that is repeatable, where you can deploy your savings, preserve your savings, and then grow the savings. So it's really, really important that system to have the discipline not to do dumb things. When I think about, okay, recommending a stock to the subscribers, I think myself, as much as possible, I try to imagine how things will look next year as much as possible. Um, I try my hardest not to be caught up in what's happening right now. And this is kind of like a dichotomy because you are deploying capital today in the environment that you are today. And I'm telling you point blank, forget today, forget like whatever's happening today, forget it. Just completely forget today. Think about next year. And it takes years and years and years of intense repetition, and you develop and you mature with time. And my best advice to people, this works for me. I don't know if it works for anyone else, but no one's ever told me otherwise. So, I'll continue saying it until um, I hear otherwise. But for me, I always think about my family and how many hours of hard work we've all had to put in for those savings, so that when you are deploying that capital, it puts a barrier on me to think, okay, this is X number of hours that we've had to grind. And I would like to believe that you also think about that as an investor in terms of time, because it's a cliche, but you can always make more money. You can always make more money. There's always ways, means, hows, whatever in the future to make more money. But time is the most precious thing we have. And I think about units of time when I'm deploying that capital. Um, Obviously, last year was very, very strong, uh, you know, but it doesn't matter. That's in the past now. You have to think about over the next year. And I said when I say to people, "Oh, I think that if we try really hard to aim for 15%, I think we should be quite satisfied with that." People are like, "What? 15%? Like I want like the S&P like at 30% every year." And it's difficult. It's difficult to extrapolate, but this is not a normal environment. So yeah, that's the first thing that I wanted to say. The second thing is that, and I say this all the time, and people nod their heads and like, yeah, that makes sense, but in practice, nobody's doing it. And if I was to say what my secret sauce is, I'd say there are two things that are my secret sauce. Number one, I don't use a stop loss. And in I think like in January it's been really volatile. Many stocks are down 20-25%. Many stocks. But I'm on those stocks. And today, in a green day like today, market's recovering. I'm kind of climbing back. But a lot of people hit their stop losses and they're like, oh, it's now a good time to get back in. And it's like every time you're kind of churning up your capital. And then you end up the year, even in a very strong year, you end up with like very little to show for it. And then when it comes to a bad year, it's like, oh my gosh, like we've like this investing doesn't make sense to me. Like just a waste of time. So that's one thing that is my secret sauce. The second thing that is my secret sauce is that I'm extremely stubborn, and this has two ramifications. Okay. The first ramification of being stubborn is that I say no to 99% of investments. 99% of investments, I say, no, this is not going to work for me. No, this is not going to work for me. So my job is to as quickly as possible get to know. Like I'm just looking for an excuse to say no. So that's the first thing that I'm stubborn with. And the second thing that I'm stubborn with is I like to sell a stock into strength. So why is a stock strong in that period? The stock is strong in that period because its outlook is good. Okay. That's the only reason why a share price would go up is because the outlook has improved. So when the outlook has improved, for a person to sell at that point when the outlook has improved seems crazy, man. It seems just absolutely crazy. And it's difficult to do. But that's how the money is made. The money is made buying low and selling high. The money is made by what you walk away from the game with. So, uh, 2 Mondays ago, I think it was 2 Mondays ago. Yeah, I think it was 2 Mondays ago. I said, "Oh, let's sell Saracen," and people were like, "Oh my God! Like, how can you do this? This is like the next Nvidia. This is going to take planet Earth over." And I'm like, "Yeah, but that's not my game. My game is if I don't have better answers than everyone else, why should I pay a higher price?" It doesn't make a lot of sense because every time that you're not selling a business, you're underwriting that business. So I sold it, and then it's better to be lucky than smart. But the risk reward wasn't as attractive back then, and the stock just kind of tumbled down. And now people are like, oh, is now a good time to get back in? I'm like, no, the setup, you've missed the setup. The setup was when we were kind of buying it at just below 8, and the setup was we sold it at 19. That was the setup. Now it's like you know kind of mixed a little bit. So you always have to think about the expectations that you are underwriting. So I use the example of a wave. And in investing, when you go into the sea, go into this wave, you never know the strength of the wave. You kind of go into the sea, and sometimes like, oh, it looks like it's going to be a really strong wave, and it just fizzles out. And sometimes it's like a weak wave. It just like, oh, whoa, it just really carries you along. So you never really know. And the wave kind of looks the same, and you position yourself in the same place, but it's just different every single time. And the same with the narratives following that business, the narratives surface and regress and surface and regress. It's an organic aspect um, that that drives in the short term the share price. Uh, of course, when I recommended to sell that business service, and I was just using that as an example, could have used a different example, but I'm thinking myself, okay, this is the amount of free cash flow that it makes sense that the business may make. Okay. And am I willing to underwrite it at this valuation or not? And sometimes you're sitting around a lot. Like I recommend Teladoc, and Teladoc I'm just kind of sitting around. And I really have high expectations for the investment, but you're just kind of sitting around for a bit. And that's part of the game, having that discipline to know that you have to be patient. And what's contradictory to this aspect of having to be patient is that when the opportunity comes to exit, you have to be disciplined to act with conviction to sell. Like, okay, it's here, it's now, let's go. So it's discipline as a big circle, discipline to react on the earnings to invest, and it's discipline to stay on your hands, and then finally it's discipline to sell when the risk reward loses the appeal. Yeah, so this is kind of what I wanted to talk about today. I'm going to open it up some questions from the audience if anyone wants to ask any questions.
Hey, Michael, I've got two questions for you. My name's Sandy. Here, I'll put on my video.
Hi, Sandy.
First, yeah, I'm new to your thing. This is like the first
Okay.
time I've ever joined. I did notice on some of your recommendations, some of your articles, you have a caveat saying you don't take positions in that name, and I'm just curious why you don't take positions in some names that you're recommending.
So all stocks that are part of the deep value returns service, I own.
Okay. I
Uh,
noticed on a couple of them there were caveats that said that you don't own them and you won't own them for 72 hours.
um, do you mean on like Seeking Alpha or you mean like on the service?
Uh, it's just whatever article you've recommended.
So on the
Back,
deep
look,
value
I think,
returns, I own those stocks. Those are stocks that I own. Um, on the Seeking Alpha on the free side, like just to distinguish the free side, those stocks I rarely own. I
okay.
so I it's just I don't really know like if you're mentioning the free service. Do you know what I mean by the free service?
Yeah, sure. I know exactly what you're talking about, but I
Okay,
did
yeah.
notice on at least one of your
Can you
recent,
mention which one?
I'd have to go back and look.
Okay.
But it's okay. You've answered my
So
question.
to be
That's all I care
100%
about.
clear, I own those names. 100% I own those names. I may have been distracted and clicked the wrong button, but trust me, I own those names.
Okay, great. Uh,
I don't, yeah, sorry.
second question is it looked like on, again, I'm brand new, so I've only seen the
It's fine, it's
last
fine, it's fine, it's fine.
several recommendations.
It's fine.
But a couple of them, it looked like you were recommending right after earnings
Hmm.
when the stock had
Hmm.
popped,
Yeah,
20 or 30%.
yeah,
And
it's
I'm
fine.
wondering, is that typical or do you try to get ahead of that?
Well, in the ideal scenario, I could see the future. I struggle to see the future. Uh, More realistically, in my mind, for example, Credo. Credo was up 35% or so, even maybe 40, I don't know, like around the day that I recommended it. In my mind, I honestly don't care what the share price has done today when I'm trying to think about next year. So absolutely don't care. I consider the valuation. I think myself, okay, let's say hypothetically, for the sake of our discussion, that Credo technology was up 40%. I think myself, okay, at this valuation, does it make sense to underwrite this business over the next 12 months relative to the future free cash flow that I see.
So you go ahead and invest after the 40% pop. You don't wait.
No, I don't wait. The way I recommend, and that you could do, and if you want, is I put 2.5% of my position on that day, and then I wait about 4 to 6 weeks, and I try and get a low price if I can. And sometimes, for example, I own this other business. You might not know it, Centrus Energy. I recommended it, and it fell like a lot, and I recommended it, and I bought some more, and it fell further, and now I'm just sitting on my hands because I've got my 5% position, and I'm just sitting on my hands. So it very much depends on the market. Sometimes, like with you probably don't know this business, but I was with Supermicro, and like there was no, it never came back down. And the same with Reddit. It's like it never really came back down. But it just depends on the market. Sometimes, so I don't know what kind of businesses you normally invest, but I invest predominantly in small caps. So small caps are really volatile, really, really volatile. So they can be up or down 20% on no news whatsoever. And people extrapolate, oh, it's up, it's exciting, it's down, it's negative. So I don't really care about that. I'm trying to think about the next 12 months. And how can I give you a good example here? In 2012, Meta announced, and you speak of Facebook announced that they were going from desktop computers to mobile. And the stock was up 45% that morning, 45% sizzled, and it never came back down. So you could still be waiting around for that. Now, I am not a buy and hold forever investor. So I'm just giving you an example of a business that you may be familiar with. I could say the same about NVIDIA in 2023. It was up 25% on February. It added 250 billion to its market cap overnight. And then from that moment on, you obviously know NVIDIA, it just kind of took over the market. So to say, oh, I don't want to invest in a stock that is up because the share price is up, that, like, who cares what it was yesterday? It matters what the valuation that you're paying right now. Does that make sense, Andy?
It does. And then last question. I've heard you talk a lot about free cash flow, and that seems to be your primary
Yeah, for sure.
valuation. Yeah. And why do you choose that over, a multiple of sales or price earnings or something like that?
So yeah, that's a really good question. Thank you for asking it. So the price of sales is what I call price to dream. You don't get paid in the sales. I know in the software business, people love to talk about sales, but that's a risky game. Depending on how hot the market is, that can be a good strategy, but you really need a hot market for that. And trust me, you're applying a price of sales, and then when the market kind of froze up a little bit, it's all of a sudden everyone's looking at price to free cash flow or something similar. So it depends on where we are in animal spirits. But if you are thinking about the animal spirits that we got lucky with in 2024, and you go through a little bit of a hiccup, you will see how quickly it's important to understand the business's free cash flow potential. You'll see it's really quickly. Nobody cares about underlying profitability until it matters.
Gotcha. Thank you.
Awesome.
Hey, Michael, I have a question
Hello.
for you. Hey, this is Haji.
Hello, Haji.
My question is in regards to your recent pick, Nebius.
Yeah, hi.
So
Mm-hmm.
two questions. I assume this is one of the NVIDIA's last December investments. That was one of those small companies. And when I look at your article, one of the graph, it says Nebius Group revenue growth rate percentage. But when I look at the Seeking Alpha, the revenue, I didn't see, I wonder for the, like the next year, 275%, and even quarter three, 766%. I couldn't get those numbers. I don't know if you wanna, if there's any way in the Seeking Alpha that you can show that. And number two is, is there, I mean, beside NVIDIA, is there any big companies start investing in this? I assume this is still under the radar, right? This is, I mean, this is one of those, we're gonna go horizontal for a while, and after then we'll start picking up.
So I'll take the first question because that's an easy one. So on Seeking Alpha, no analyst yet, as in like no sell side analyst yet, follows the business. Therefore, there are no ratings. But when they have the first earnings call, end of February, they will the sell side will sit down with management, blah, 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 and then like a few hours later or a few 24 hours later or whatever, they'll update that. So yeah, don't worry about that. That will come. The second thing is about whether the business will go sideways for a bit. Listen, you were able to predict the like where the business will go in the share price will go in the next whatever week or two. I have no idea. Like,
Okay.
and as I said at the start of the call, don't think about now. Do not think about what's happening now. Think about next year. Okay. So on the analyst presentation that they had when they were trying to raise capital from NVIDIA and other ones, but I don't even think that NVIDIA put that much. Maybe they bought 2 shares. Like it's just for basically the press release, and I just wrote it because people like that kind of stuff. But for all intents and purposes, they probably even gave the shares to NVIDIA just to get it in the press release because like NVIDIA is the hottest company in the world. They don't even need to put any capital down. But what they said in about July time was that they were going to make approximately at the end of this year they were going to make approximately 500 to a billion of annual recurring revenues. Now, when they came to raise capital, they had to have another kind of analyst day and blah blah with big investors, and they raised the bottom line, the bottom of that guidance from 500 to 750 million. So they're telling you they're going to make this year approximately a billion to 750 million. So in our ballpark, at the end of this year, as an annual recurring rate. So let me just unpick this slightly. First of all, it's not that they're going to be making that in terms of revenue this year, okay? It's at the end of the year. Second of all, they've actually taken the last month of 2025 and times it by 12. So it's not even the last quarter, it's really the last month and times it by 12 and taken that forward as an annual recurring revenue rate, which in simple terms really means not this year, 2025, but 2026, they're going to make about $1 billion in revenues. Thirdly, I really like this business because, when Yandex in Russia, Yandex was, it is massive. Yandex is massive. Like for people that from Russia, they don't really use that much Google. They use Yandex, but the world is quite global, so they also use Google. So, but the team that built Yandex to compete with Google, they did quite well. Obviously, they're not Google. Not every business is going to be like Google, but they did quite well. But so they had loads, like a conglomerate, like they had this business, that business, self-driving cars, that, like loads of different projects. So they sold, I assume, about 93% of the business. They sold that. They got some 2.2 billion of cash for that. And what's left is this tiny little, like microscopically small business, which is kind of like an AI play, really. And what they're trying to do is buy from NVIDIA's those GPUs, build a cluster of data centers, and sell that as a service. But as you'd expect, building a data center is incredibly capital intensive. So I assume that in this year, 2025, they will have to raise, I think, around about 500 million or so they'll have to raise, which is kind of approximately 5% dilution. So they'll have to dilute the shareholder, which depends on how hot the market is. Like if the market is not particularly hot, and you say that you're going to have dilute shareholders by 5%, people like puke that out. Or if the market is hot, it can be just like people take it in the stride and it just, but it will be volatile. It will be volatile. Until it becomes a more familiar play where shareholders are kind of more institutionalized and more kind of less likely to sell on every hiccup. So that will take a bit of time. So in the interim, the share price will be very volatile. And if you're realistic with yourself when you look in the mirror and say, you know what, this is quite volatile, I'm not quite sure. Look at liquidity services. Look at maybe Teladoc. Look at something else.
Yeah.
You have to be honest with yourself, and you can say, you know what, I kind of want some exposure, but I'll just put 2% in, and just sit on my hands, and that's going to be fine for me. You have to kind of have a frank conversation with yourself, because I know myself that I'm quite happy to sit on my hands and wait. I'm quite happy, but you need to know yourself. You really have to see what your investment strategy is and whether you're truly able, in your experience, to sit on your hands and not react.
Okay, thank you, Michael. I appreciate that.
Hi, Michael. It's Lester here.
Hi, Lester.
Yeah, just a question really on the risk management. I think, the way that you spread and put minimal amounts in a number of shares, obviously one piece. But not setting stop losses, I quite understand on the volatile shares. But what else do you take into account when you're looking at the risk management side?
Thank you for that question. So I look at two things. Number one, I want the business to have a balance sheet that's kind of like a second margin of safety, okay? Because for me, the North Star is the free cash flow, but I want that second layer of margin of safety to be the balance sheet. I spend a lot of time thinking about that. I just talked about Nebius, and I was like, okay, yes, they have a strong balance sheet. They have approximately 3 billion, no debt, but how much capital are they going to need? I'm thinking about that all the time when I think about my investments. So the balance sheet is something that I very much spend time on. And secondly, I think about diversification. So in the same sentence that I talked about Nebius, it's like GPU clusters, blah, blah, I also said, hey, something like Teladoc, which is kind of like completely unrelated. So that when the market kind of gets, enthusiastic about AI, they're not going to be enthusiastic about healthcare, and vice versa. When they're enthusiastic about healthcare, they're not. So just to kind of smooth out, the way I think about it is that I am ensuring peace of mind for myself, because I know that, I have the paying subscribers, and I know that it's difficult to have the stomach when the market is not hot. It's difficult to be investing in small caps. But that volatility is the price that I pay for the strong returns. Now, everybody in the world, no matter what they say, they want smooth returns. No matter what they say. It doesn't really matter what they say. I'm experienced enough. It doesn't matter. They would much, 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 much rather get a smooth 8% than a volatile 10, no matter what they say. So I benchmark myself against the S&P, and I deliver the outperformance, but the cost that I'm paying is the volatility. So everybody wants strong returns, and I try and educate people to stay with the journey. The way I say it, like, pick out 5 names and equally weight them. Obviously, someone wrote to me yesterday, oh, Michael, you know what? I just got a few people online. A few people actually told me this. I've got all your stocks in like a portion of my portfolio. I've just kind of put, like, someone said like 50%, someone said a third, and they just kind of got all my stocks. So they kind of want to mirror my portfolio. And I'm just going to sit on my hands and do what you tell me. And that's fine for that individual, and it may not be fine for you. So, but at the minimum, to do service to myself and to yourself, I say buy 5 stocks, equally weighted. If you just want to put, let's say, 10% of your portfolio into my stocks, that's fine. Allocate 10%, buy those 5 stocks, 2% in each, and that's hunky-dory. Don't try and rush the process, because when the market is hot, deep value returns is hot, and you think that you can speed up stuff. You can't speed up stuff. Relationships take time, you know, it really takes time to kind of get to know my process, and you can't rush that. But once you've been in the service for a few months, you kind of see, you know what, this actually kind of works. Then you can maybe increase the number of positions.
Okay, quite understood. Yeah, thanks for that nudge on Nibius, by the way. I mean, I worked in Russia for 5 years. My wife's Russian, and saw someone else in the group the same. I mean, personally, I think that guy's a genius. I'd seen he'd sold out of all the Russian assets, so I've been meaning to take a good look at it, and you saved me a pile of work. So I jumped in yesterday for sure.
Cool, man. Thank you. Thanks so much.
Thank you.
Hey, Michael, I have a question about Nebius as well.
Mhm.
It's more about the fundamentals. So I was looking at your report, but I was thinking, and how do you value a company that's like growing at 250% with negative FCF? Because to me, if you try to draw an Excel and do whatever calculations, DCF doesn't work. Like there's too much uncertainty.
100%.
How do you arrive at 60?
Okay, you intelligent guy, you're asking the right questions. Let me get, if you take nothing from me, take this one thing. Stop using a DCF. If you take nothing else from me, use your brain, use common sense, stop using a DCF. That's the first thing. Take that for free, okay? Even if you get nothing else from this call. The second thing, you're right. A business that is growing really fast and hasn't got any underlying profitability, it's incomputable. But what you have to understand about investing is different from accounting. Investing is about the change in people's expectations, okay? So I keep going back to this aspect that you can't think about today. You have to think about next year. And if, for example, you're talking about, in this example of Nebius, the business, by the end of this year, 2025, they're going to be EBITDA profitable. Now, I said many, many, many times, there's going to be highly CapEx intensive. Therefore, this means they're going to be free cash flow negative. They're not going to be making any free cash flow. They're going to need to raise capital. So perhaps maybe a good way to think about it, not that it's really comparable, but it would be like Amazon. When Amazon was kind of growing a lot, Amazon was highly unprofitable. And in fact, even to this day, outside of North America, I believe that once you remove the UK from Europe, I probably bet that Amazon is quite unprofitable still today, but they're still investing for that growth, okay? So what you are looking for with the Nebius or another business, whatever it could be, that is growing really fast, you're looking for how long do I have to underwrite this business until it's closer to them making free cash flow? Because when a business, just for the sake of our discussion, goes from growing at 250% to growing at, let's say, 25%, but with 2% free cash flow margin, people are like, oh my God, this is like a really profitable business, high growth. You add a little bit of a narrative to that and say, oh, it's AI, blah, blah, blah. And people are like, oh my God, bananas, let's go. Price of sales, 20, let's go. But you need to do the underwriting today at this point for where it's going to be at the end of next year.
Okay, thank you. I think that
Do you want
makes
to ask
sense.
any other question? I like your question. Do you want to ask any other question?
Maybe. Oh, sorry. No, I was just like a small elaboration on the same point is how do you reach 60? Because it makes sense, but I can say 80 or 90 or like 70.
For which one? Can you
kind
tell
of
me
hard to gauge.
Which stock you're talking about?
Like maybe Nebius, like I say, okay, people get excited about AI, NVIDIA, then maybe you can push to 70 or 80. How do you reach the concrete number in a sense?
I just looked on the analyst presentation from I think it was end of November. It just said that they're going to reach EBITDA profitability. So I didn't do anything. I just looked there I didn't do anything. I just took their number.
Okay, fair.
Okay. Any other questions?
Yes, this is Bopender.
Hello.
Hi, how are you?
Yeah.
Okay, good. My question is, when I look at the deep value returns tab,
Mhm.
and it has your second tab, and it has a link to the company. And when I
Mhm.
go to it,
Oh yeah, I'm not very good at remembering to do those links. I'm sorry. I keep
no,
thinking.
no,
Yeah, yeah,
it work. Links work. But my question is, like, for instance, NBIS.
yeah.
Do you use these because they've got a hold on it? Valuation is C, but usually, I see that there's a growth.
I never look at that. No, I like. You mean like what the quant system does?
Yeah.
Yeah. I've never looked at that. I've never looked at that.
Okay, because yours are hold. But
Sometimes they hold. MicroStrategy will sell. I like when I was selling up loving, it was a buy, strong buy.
Yeah.
Everyone has their own strategy. I just got to do my own.
Yeah, because there's another service I
I
subscribe to.
know. Are they still on with Uplovin? Yeah.
Yeah,
Are they,
but
are they still?
LA, I still belong to LA Stevens, but
Yeah.
Alpha Picks, they use this quite a bit.
Yeah. Okay. Cool.
Yeah. So
Good.
okay.
Very nice to see you.
Thank you. Here.
Thank you so much. Okay, everyone. Thank you very much for coming, and a really nice turnout. And I'll see you next Tuesday. Thank you very much, everybody.
Thanks a
Okay.
lot.
Thank you,
Have
Michael.
a good day, Michael.
Thank you, Michael.